Kevin Hassett is back at the White House, a senior economic advisor to the president. Is like G3. They keep pulling you back in, don't they, Hassett? Was this voluntary? Someone's got something on you? Why would anyone do this? Anyway, it's good to see you. The coronavirus crisis will end up causing unemployment rates similar to those in the Great Depression. I want to get those, what your forecasts are for that eventually, because it just is so frightening and earth-shattering, but we should get it out on the table. So where does unemployment, I mean, we're shut down, so it shouldn't be a surprise. What's the actual number for total unemployment, the worst that we get, and how bad will the second quarter be in terms of GDP?
Right. Well, thanks, Joe. And I know it's a somber time, and that you mentioned me coming back. It's an emergency situation, and I thought I had pretty much moved on to the next stage, and I came back. Yep. And I know you would have done the same if the president asked you, although maybe things wouldn't be going so smoothly if you were here, rattling about. Who knows?
You never know.
I guess so. I know. You've got lots of good ideas. Yep. Well, so anyway, I think that the way to think about it, sadly, is that all of these UI claims, unemployment insurance claims that we see, add up to unemployment. And a heck of a lot of them happened after what economists call the survey week. And so the really bad news that we've been seeing in the initial claims will be spread out over a couple of months. But I'm expecting that when we see the unemployment rate for the first, I guess it's going to be the first week of May, we're going to see a number that's going to be maybe 16, 17%. Right now, if you take what happened at the end of the first quarter, we're getting that first quarter GDP number this week, then you're looking like it's pretty likely you get a negative number. And then for second quarter GDP, it's going to be the biggest negative number that we've seen since the Great Depression. And I've seen it actually, a lot of it's going to depend on weird assumptions that the BEA makes about whether a school that's shut down but maybe is doing a little bit of telelearning, whether that counts towards GDP or not. And so that could end up moving the number up or down 10%. But you're looking at something minus 20 to minus 30% in the second quarter. And then the question is what happens next. And that's what we're focused on right now at the White House.
Well, you're talking to doctors and scientists about what's next. We don't know about a second wave. We don't know about reopening. And even economically, once we do reopen, we don't know how consumers are going to feel. And whether you reopen, do you get 20, 30, 40% of the business returns, 60%? We don't know. It depends on which business, obviously. So is it looking like something between a V and a U, or is it looking like an extended U? What do you think the bounce back looks like? What's the third quarter going to be?
The third quarter should be pretty positive, because if you think about it, if all the folks are sort of locking in place and then they start to move about, then you kind of have to go up from however far you drop. And so I think the third quarter is very likely to be positive. And I think that the sort of puzzle is that incomes are staying relatively high, but output is going to zero. And so when you see the GDP release, there are going to be all these things that usually add up to each other that are going to be far apart. And I think that if the virus does start to go away in a way that makes it so that most every state feels comfortable that it's safe to open up, then we really could be looking at a pretty rapid recovery, because the incomes are still there. But there's a pattern in the data that we've noticed, because that's what we're doing every day, right, is we built this system to monitor the economy and the health of Americans and interact with them. One of the things that we see that's really interesting is that if you look at a typical county somewhere in the U.S., then it might be a county that has something like a defense plant where the workers still have to go to work, or it might be a county that doesn't have essential workers at all. And one of the things you can do then is look and see, since this crisis began, what's the different disease spread outcome look like for places where everybody was going to work because they're all essential workers, as opposed to places where people weren't really going to work because they weren't essential workers. And the thing that you see is that at the beginning of this, there was rapid spread, sadly, in the places where there are a lot of essential workers. But the variance has really declined over time, suggesting that people have learned from Drs. Birx and Fauci about safe practices, that manufacturers and other essential services have figured out how to do it in a much more safe way than they were doing 3-4 weeks ago. And it suggests, to me anyway, looking at that if we had let everybody stay open 4 weeks ago, they wouldn't really have known all the things they know now about what to do, and the disease would have spread much more rapidly. But now the variation from the places that are most open, because they have lots of essential workers, to least open, the variation is almost non-existent. And so it looks like people have figured out how to get back to work and to do so safely.
All depends on what none of us know, though. That's the problem, Kevin.
That's right.
Whether there's herd immunity, whether there's whether it does in the summer months seem to ameliorate almost entirely, whether we get a vaccine, if we got a great therapy. Right. I can tell you one thing, though, Kevin. If it was totally safe and people didn't think that there was any chance of getting infected, the restaurants would be teeming. You'd be, I mean, I'd go to a Greasy Spoon and wait, in line to go in there. I'd go to a movie theater and wait in line to see Beaches. Yeah. I would, any of these things, a sporting event, I'd go wait in line to see a curling event. You know what I'm saying? I mean,
yeah, everybody's dying to get back to that.
The pent-up demand is unbelievable, but that's a long, long way from where we are right now to what I'm describing. And there's a lot of middle areas that aren't anywhere near that are probably more likely than a complete, safe environment to go back to. So how do you factor into that?
Right. Well, the way I think that we factor it in, it's something we've discussed a lot and then even started to prepare guidance about, is that the way that 9/11 changed a lot of our practices. So you remember you used to walk your mom to the plane and actually waved her as she's boarding, but then they set up security where only the person with the ticket went through and they had to go through the metal detector. That I think that a lot of things changed in our lives that are going to be changed forever, but the new changes, the new practices, that they'll make us safer. And so I think what's going to happen is that we'll figure out what practices we need to engage in order to operate safely. The one, usually when I was here before, we had nothing but good news to talk about, and this is really a time where we're going to see bad news after bad news. I would say that the bright spot for me in all this is one that, despite the partisan sniping you see, we got together and we took some very extreme action, passing unanimous consent in the Senate and so on. And so I think that the patriotism of our politicians has really come through, despite the sort of bickering that you see around the edges. And so what it means is that we're in a pretty good place so that if we see more policies are necessary, we can be confident that those will happen. And the Federal Reserve has really stepped up as well, taken very extreme actions with their Main Street lending program and everything else. And so I think that one reason why, as you guys cover markets every day, you can see that markets have been reasonably calm through this giant black swan event. I mean, it's like a black swan, if you're going to make one of those old Japanese horror movies, like a Mothra-sized black swan, and yet the markets are kind of saying, oh, okay, we think we can deal with this. And I think it's because policy actions have been smart and sensible and timely, and that gives people confidence that as soon as the virus is under control, or at least diminished enough so that states, according to the guidelines, can open up again, then we can go back to being about where we were in January. And so I don't think you remember the Reinhardt-Rogoff debates we used to have on your show about during the Great Recession about is it going to take 10 years to recover? I think that we'll have that debate again once we get past through this sort of crisis stage. And my view is that Kevin, we won't make the policy mistakes that extended it last time.
Right. Kevin, question for you. During this whole bailout situation over the past several weeks, the government, the administration, and others, journalists, the media, have jawboned a lot of companies that took PPP money and are now returning it because they've effectively been shamed, whether they've been shamed at the White House or been shamed by the media. And the more I think about it, the more I think there's going to be a sort of perverse reaction to all of this, because a job is a job is a job, and even some of these big publicly traded companies that have money ostensibly are still going to furlough or fire their workers during this period, whether they take because these programs are effectively employment for all programs. You're either going to take the money through the company and pay the people, or they're going to get unemployment insurance. And so the question I have is, which is the better alternative?
Right. Well,
from an economic perspective.
Yeah, economically, the best alternative is that the worker stays connected to the firm, and then as soon as the firm's ready to go, then they don't have to try to find the worker and retrain them that they're there, they're ready to go. And also, don't forget that as we get ready to turn the firms on, then they'll have to probably, as we were talking about airports, they're going to have to change their practices. And so maybe restaurants are going to have to move tables further apart or construct screens between tables and things. I'm not an expert, but I'm just hypothesizing. those workers will have stuff to do, even if there aren't a lot of customers coming in. And so, for sure, there have been some problems, but you got to say that the program has been a tremendous success. That they've lent money to more than 1 million firms with 10 or fewer workers. There were 1,800 banks making these loans at the beginning, and the banks were making loans to their own customers, and so therefore, if you weren't a customer of one of those banks, you were shut out. But now 5,000 banks are offering the loans, and so a lot of the problems, the early problems, were happening because we were trying to get the money out fast because we're very, very distraught by the potential of the surge in bankruptcies that we would see if we didn't make these loans available. Given the surge in initial claims that we've seen, normally there's a pretty strong relationship between initial claims for unemployment insurance and bankruptcy. We'd have lost about 1 million firms that we haven't lost, I think, because of these policies. And so, sure, they've got some glitches, but I think that they've helped us build this bridge to the other side that gives us at least the potential for a V-shaped recovery.